Good afternoon, everybody. This is Jade Friedenson with IMN welcoming you to the third in our summer warm-up webinar series on ESG finance. We're just going to give it a few moments before we kick off to allow some additional people to join us. Thank you. Okay, once again, good afternoon, everybody. We're up to 113 participants so far. We're just going to let it go for another minute or so before I turn it over to our moderator, just to allow some people to dial in and join us this afternoon. Okay, so without further delay, this is Jade Friedenson with Information Management Network, and I want to welcome everybody to the third webinar in the Global ABS Summer Warm-Up Series on ESG Finance. This is the summer warm-up series because, of course, we're getting you geared up for the main event, which is the virtual Global ABS Conference. If you haven't already marked the dates for that, please do so. It's September 15th through 17th. And it's 3 full days of on-demand and live content, and participation as a member of the industry is complimentary. So if you haven't taken advantage of that by registering, please do so by going to the Global ABS website, and go ahead and take advantage and register today so you can get all the upcoming announcements on keynote speakers, etc. So without further ado, I'm going to turn it over now to Anna Back, who is the Associate Director for Securitization with our event partner, AFME. Over to you, Anna.
Thank you, Jade, and hello. Welcome, everybody, to our ESG finance panel and the role securitization can play in the ESG finance. As Jade said, my name is Anna Back. I'm an Associate Director at Securitization Division at AFME, and I have a pleasure to moderate today's discussion. Also, please join me in welcoming our panel of experts. And I'm here today with Matthew Mitshel, who is a Director at EMEA Structured Finance at S&P Global. Tim Conduit, who is a partner at Allen & Overy, and Anuj Babber, who is a head of ABS research at M&G Investments. So hello to my panelists and welcome. And again, welcome everybody to the webinar. I know we're in a slightly different settings that we would be normally at the Global ABS with the current situation, but nevertheless, we will try to keep the panel discussions as it would be happening live in Barcelona. So turning to our topic today, ESG, I will first just start with a couple of introductory remarks. I think as we are all now trying to tackle the pandemic crisis and searching for a solution to economic recovery, it is becoming more and more evident that ESG considerations, so the environmental, social and governance considerations, will play a more and more important role in this economic recovery process. And it is indeed expected that those considerations, those ESG principles, are expected to shape the future of the capital markets in Europe and globally. And of course, securitization is a part of capital markets. That's why today we want to talk about ESG finance in the context of securitization. And as you may have seen, or I don't know how closely you're following this topic in general, but the policymakers and regulators globally have given us recently very strong indications that ESG principles will be taken into consideration when it comes to the regulatory analysis and decision-making processes in the coming months and years. So this is a subject that is definitely increasing in its importance. Looking at EU, especially here, we have seen this trend since the announcement of the Sustainable Finance Action Plan that was back in 2018. But more recently, the announcement of the EU new Green Deal strategy, and then the publications of the EU taxonomy. Those are the kind of the key developments that has taken place recently in that space. But only yesterday, European Commission have actually closed the consultation on its renewed sustainable finance. And in that consultation, there was a separate section dedicated to securitization, to green securitization. And this shows how important this subject is becoming. And it shows also the European Commission's interest in securitization and its potential role in sustainable finance. Of course, AFME have responded to that consultation, and we have actually flagged to the Commission that the focus there was on the green aspects, so on the green securitization, so the environmental aspects. But we said that it is now also the time to look more at the other factors, at the S, at the G, as they will be more and more, I think, important in the upcoming recovery process. Now, taking aside the EU political or policy agenda, the ESG factors became also increasingly important for the market participants. I think especially for the investors in capital markets and, of course, in securitization. So it just all shows that this subject is not only popular and it's not only high on the political agenda, but it's also increasingly important for the market practitioners. And I hope that in today's discussion, we can show you a little bit more how those considerations can be applied to securitization. So now turning to our panel discussion, I think, of course, it would be good to start to start with trying to define what the ESG are. We talk about them, but there is no clear definition. There is no clear standard. So it would be good to start the panel looking in how the securitization is actually perceiving the ESG principles. What are they? And I would like to start maybe here with Anuj as an investor. From your point of view, when you're thinking ESG in securitization, what does it mean to you?
Hi, Anna. Thank you very much for that. Look, let me start by saying that at M&G, we believe that ESG is a very important component of responsible investment strategy in all the assets that we invest in. When we look to drive ESG factors in our securitization analysis, we've taken the principles of ESG that we've currently got in equities and other credit spaces, and we look to incorporate some of those into our structured finance ESG analysis. Now, as you can imagine, it's not been very easy, and it requires a very nuanced approach. as it does in other securities markets. But it's no surprise that, and on the back of this, that there's no real clear definitions of what ESG principles in ABS really are. I guess, it's also right to say that, when compared to, say, the equity markets, the securitization community is at the infancy of incorporating ESG analysis into its credit and investment decisions. For one, if you think about it, there's no third-party scoring systems such as Sustainalytics and Bloomberg indices that you get in other credit markets. And so we don't have anywhere to benchmark to. But what we are seeing, and we'll probably hear from Matt a little bit later on as well, is that some data providers have tried to come up with frameworks which are a blend of mostly qualitative and quantitative factors in order to assess the materiality of ESG factors on the ratings output. I guess another sort of complexity when you think about ESG or the securitization market is the complexity of a securitization structure. Now, by design, it's a transaction structure that has a whole number of different counterparties that can have a very significant impact on the performance of the transaction as a whole. So, it's very important in those cases to take into consideration the ESG factors for multiple counterparties in order to form a balanced ESG sort of transaction level view. And some of the examples I give here are like, if you think about a transaction which has a third-party swap in the transaction, which has a material economic impact on the cash flows of the transaction, or take an NPL transaction which typically has a third-party servicer, you need to be able to assess the ESG factors on those entities as well as the originator and the issuer when forming a sort of holistic ESG sort of view. Now, when we started to think about how we incorporated ESG into our analysis, and this is going back a few months now, when I was challenged with that thesis, I sort of looked at the way that we analyze transactions through the ESG lens. And yes, we weren't calling it E, S, or G, but when we looked at our due diligence processes or our analysis, you could attribute different factors to E, S, or G. Mainly the sort of G and S, and E was probably a little bit more nuanced towards more commercial property markets. But for instance, just to give you a sense, our due diligence focuses on issues such as corporate structure, alignment of interest between borrowers and lenders, servicer practices, regulatory compliance, responsible origination practices, data and documentation transparency as well are a few of the things that we look at. But if I was to pick up on one topic that we've really focused on quite a lot over the last sort of 12 to 18 months, it's been documentation and documentation in, really in respect of LIBOR. There's a lot of talk around LIBOR issues in the UK, and the FCA and the regulators are trying to get people off issuing in LIBOR and investing in LIBOR as well. And we've either through sort of direct conversations with issuers or forums worked to provide a sort of level playing field in terms of good LIBOR language in deal documentation. And I think, I'll leave it here, but just one last sort of factor when we think about securitization and the nuanced approaches that we need to take when we look at securitization, look at ESG analysis within transactions, is the fact that securitization touches a lot of different asset classes. You've got commercial property, you've got residential property, you've got CLOs, you've got aviation, and therefore you're going to have a very nuanced approach to each of those different sectors. And I think one of the things that we're going to have to incorporate and get it better over time is, standardization of data, and we'll talk about that a little bit later on as well, but also a lot of engagement with the issuing community as well. So that's something that we're keen to do. As we said, it's in its infancy at the moment, but hopefully, it sort of starts to take more effect, and we're happy to engage with issuers and arrangers alike.
Great, thank you very much, Anuj. And Matt, turning to you, the perspective from the credit rating agency, what's your approach to the ESG in securitization?
Sure. So the first thing that I always differentiate between when discussing ESG is how these factors can impact credit quality versus how ESG friendly a securitization might be. And while it's important that securitization technology could be used as a funding tool to achieve sustainable development goals, and actually I've been calling that sustainitization, and I'm really hoping that that catches on. Our focus as a credit rating agency remains, how does ESG impact credit quality? And really echoing Anuj's comments here, we have always considered ESG factors in our framework, although, historically not typically putting an ESG label on them. So therefore, our current effort is really focused on increasing transparency around which of those risks within our existing analytical approaches we would classify as an ESG factor, as well as then how does our analysis change or adjusted if one or more of these factors is present in a transaction. So we focus not only on the ESG characteristics of the assets themselves, but we follow a 5 pillars approach. So I think, again, similar to how the buy side was looking at this, we're looking also to the transaction counterparties, any operational risk in deals, legal regulatory risks, and lastly, just the overall governance of the structure itself. And that really, I think, ties into the LIBOR point that Anuj was making. Unlike other sectors, structured finance is unique in that if there are elevated ESG risks, there can be structural mitigants in place, such as credit enhancement levels. You might have a short life of the security relative to a longer term risk. There might be performance or replacement triggers in a transaction. So those really can mitigate a risk, which is unique when looking at something from more of, I think, a corporate ESG perspective and the impact on the issuer's credit rating, as opposed to the issue level ratings that we assign in structured finance. One other thing that I do want to highlight as well is ESG risks may be viewed as indirect to us rather than direct, and therefore they're already captured by other aspects of our analysis. So we would typically only classify something as a credit factor, an ESG related credit factor, when it is a direct consideration in our rating analysis. And by direct, I'll give a recent example. So this is for COVID-19. We would classify COVID-19 as a health and safety related social credit factor. But you'll see that there have been numerous rating actions, but really only a small percentage of those we would say have been driven by ESG. And we would call a direct ESG factor in this instance as something where health and safety has resulted in health concerns or social distancing measures, et cetera, that have actually impacted the entity or the cash flows to the securitization itself. So that's going to be sectors such as corporate securitizations, rental car ABS, or CMBS with hotel retail exposure. I think that's where we view COVID as having the direct impact on the ratings, whereas looking to other sectors such as consumer ABS or RMBS, while there have been rating impacts there, we believe that those are more driven by the economic recession related impact, so wouldn't necessarily view COVID there as being kind of an ESG credit factor.
Thank you, Matt. That's, I think, very informative from a point from both of you. And we touched a little bit about already about the disclosures and the transparency. And I think this will be one of the key drivers of that sectors. So when we're looking at the disclosures, I'm going to turn to Tim now and ask him what are the current regulatory requirements that deals with the ESG, especially when it comes to securitization, but also maybe how that compares with different sectors.
Thanks very much, Anna. It was fascinating to hear Anuj talking about LIBOR transition or LIBOR legacy assets as effectively the G in the ESG universe. And that's really interesting because it demonstrates that this is a very holistic set of criteria, issues, considerations, criteria that need to be taken into account. But it's fair to say also that specifically regulatory and mandatory disclosure has been very slow to catch up. I think what there is in the market is really focused on the E. And so I make no apologies for a second in focusing mostly on environmental and climate related mandatory disclosure. Well, not just mandatory, actually. There's a significant number of voluntary initiatives in the market in relation to climate related disclosures, like the G20 task force on climate related disclosures, which is again looking at transparency in disclosures to enable them. I think the words they use are consistent, comparable, reliable, clear, and efficient. And that's really what we're aiming at. We're aiming at saying, if there are risks, if there are benefits, tell us about them, but present them in an understandable way. On the more mandatory side, and again with no apologies for sitting on the E side of things, in the UK, the Bank of England, wearing its prudential regulatory hat, is requiring firms to demonstrate how they deal with climate-related financial risks. So that's very clear to say that, look at the risks inherent in your business, demonstrate to the market and to your regulator how you're going to deal with them. And as with actually much in that sphere, the EU is leading the way in its disclosure regulation now supplemented by the taxonomy regulation, which has actually just been published. It's going to come into force very soon, and it sets out specific sustainability disclosure requirements for financial products to demonstrate whether they promote environmental objectives. And for those of you who aren't familiar with the EU's work, the environmental objectives really key off the EU Green Taxonomy, which was published some months ago, which sets out effectively it divides the world into what is green and what is not green. So environmental objectives are what falls within the taxonomy. Interestingly, that will also bring in a requirement for non-sustainable products to specifically say that they don't take into account the environmental criteria. It'll also oblige credit institutions, so banks and insurance companies, to include in their reporting to what extent their activities are associated with activities which are promoting environmental sustainability. So there's quite a lot in that, but there's virtually nothing specific on the social and governance side. And I think it's important also to realise that in the securitization sphere, we have some specifics that we need to think about. I mean, one is for, to take an example, for deals that are listed in the EU, the basic disclosure requirements under the prospectus regulation will require significant disclosures of risks. And I think probably we're all dealing with questions around how do we disclose COVID-19 risks, which are probably somewhere in the E and the S buckets of ESG. And to be fair, those are very difficult questions, especially when regulations don't really pinpoint exactly the sort of matrix of disclosure that's required. And then to look specifically at regulation of securitization under the EU securitization regulation, there is a specific requirement to report, and the securitization regulation sets out a lot of reporting requirements, which we all know, love, and deal with regularly. But and that actually also goes generally to transparency and highlighting risks and highlighting performance. So it goes to ongoing reporting, which is going to touch more generally on ESG provisions. But the securitization regulation specifically talks about a requirement to report on the environmental performance of residential loans or auto loans or leases. So again, focusing specifically on the E aspects, but there are a number of sort of mandatory, market-driven, voluntary aspects which require corporates in the wider sphere to start to think about overall ESG disclosure.
Thank you very much, Tim. Now, I think also when we talk about the transparency disclosure, I think the next thing that comes usually to my mind is the data, as it is something that needs to be disclosed, obviously. And I think sometimes we also experience some challenges with the data, especially in the new sector. So again, I think it would be good to maybe to look a little bit, what data is available there and what are the potential challenges. And here I would again turn to Anuj to maybe give his perspective on what is available and what challenges you see as an investor.
Yeah, sure. Thank you. Look, Tim made some very good points there. A lot of the data that is being requested right now is focusing on the E rather than the S and G. But if you think about, he touched upon the securitization regulation as well. Article 7 of that disclosure of that regulation is disclosure by issuers. And that has really bridged a big gap in sort of the G component and made it more uniform across different issuers. And we appreciate that. But as he said, the ESMA templates go so far, they don't go far enough, right? There are only the two templates that we talked about, the auto loan template and the residential template, that actually force you to put that data in there. Now, we do get some data in commercial property. In the valuation reports, you'll get ESG sort of driven commentary in there as well. So we can incorporate some of that. It's not uniform, which is always the challenge in a lot of this stuff. But a lot of the challenges also, when you think about ESG data, is how do you quantify something? You can quantify carbon emissions and so on and so forth, but how do you quantify, say, non-conforming lending or the risks of lending to an underserved community? And that is a little bit more of a qualitative adjustment and nuanced approach that you have to take in that regard. And a point that I missed out in the first session is when you think about a newest approach, it's each investor might think of the risks very differently, and therefore when they apply the data or they apply the information that they're getting in the various ESG components, you can come up with very different decision makings on the back of that. Look, I think we're going to have to engage with a lot of issuers. As you pointed out, I think, Anna, you were alluding to the fact that there are a lot of newer originators in this market that lack the sort of performance history or lack the data capture, and they're not being forced to do so. So hopefully, with some of these regulatory initiatives that we're seeing, either through the securitization regulation or the other regulatory efforts that are being played out right now in terms of this the green policies, we're going to see a little bit more standardized data and uniform data that we can use and relate to in an ESG fashion.
Thank you very much, Anuj. And Matt, turning to you from the rating credit rating agency perspective, how does securitization compares to other sectors when it comes to availability of data?
Yeah, so speaking both with external market participants as well as my colleagues across the ratings organization, I'd say this has really only come into the structured finance lens probably in the past year, I would say. It is when we've really started to get an increase in inquiries with respect to, well, what data is available? How does it fit into a structured finance framework? Meanwhile, for several years, there's been initiatives in both the equity space as well as on the corporate reporting side to try and standardize these disclosures. And one common example that's brought up is the SASB disclosure requirements. Right now, nothing exists for structured finance, and you get the additional complexity that you can't just group all structured finance into one asset class, as a CLO is going to be very different from CMBS and RMBS, ABS, etc. I'll say there has been some recent progress, which is encouraging, in order to try and develop a common standards for structured finance. So these include both the Structured Finance Association launching an ESG working group, as well as there is a structured products working group currently with the UNPRI, and I understand that they are going to publish a position paper on that, hopefully some point this year, recognizing that COVID might delay that, but at least that work is now underway. So it was more that a lot has gone into the equity side and the other, corporate bond space. What can we leverage from that and learn from that and apply it to structured finance? One effort that we're doing, and this really addresses some of the comments that Anuj made with, how do you measure some of those qualitative aspects of maybe a social or governance factor? So what we'd like to do as a rating agency to increase transparency is benchmark the relative exposures, at least, of environmental, social, and governance factors across the different sectors, and then highlight in our analysis when an individual transaction differs from that sector benchmark. So one example here would be, looking at secured receivables versus unsecured or concentrated pools versus diversified pools. We would probably view a secured concentrated pool to have a higher relative environmental exposure than an unsecured, highly diversified pool, such as a credit card, for example. So we want to start with those sector benchmarks. In our reporting, start to highlight, well, how does this deal differ from the sector? And then look at, well, how does our analysis change as a result of that particular ESG risks, and what structural mitigants might be in place that, in our view, mean that there might not be a ratings impact as a result of that. One other thing that we've done as an organization is really, again, leveraging what work has gone into the corporate space, is we do have at least an internal common taxonomy for the different ESG credit factors. And speaking with institutional investors, I think the same applies, that they've done all of their mapping for the corporate bonds, and now they're trying to integrate that same mapping framework or a similar mapping framework into structured finance. So for us, we want to use the same sub-factors of environmental, social, and governance. And one of the ways that we're adding the transparency in our disclosures around this is actually the new EU disclosure regulation that became effective the end of March. So for credit rating agencies, it means when an ESG factor is a primary driver for us in a ratings change, we need to be including that in our media releases. So you will see in any release that goes out, when ESG is a ratings driver, we have a dedicated section now, environmental, social, governance factors, with the specific bulleted item as to which of those factors was the driver. So definitely I would say that the EU is the most advanced in this, and really echoing what the co-panelists said, there are some disclosure requirements in the new securitization regulation with respect to autos and mortgages, but it's very, very limited data today. The other challenges is even where we do have access to data, and environmental risks is the easiest one to quantify, so I can run with that. It really comes down to, do we have the information in a form that gives us sufficient accuracy to assess these risks? As for flooding risk, the difference between having a 1 kilometer accuracy versus 100-meter accuracy could result in a very different outcome for the relative flooding exposure for, a pool of residential mortgages, for example.
Great, thank you both, Matt and Anuj. I think it's quite an important topic of the data. But I guess one of the other questions that I guess is one of the most important here when we're talking about ESG. Actually, what is the market appetite for it? I mean, how much interest is there? And as I said at the beginning, it is an interesting topic and high on the political agenda. But I mean, what is an actual driver there? What is the market appetite? And again, here I would first maybe look again at you, Matt, from your perspective. I mean, we see that ESG has taken off quite substantially in other sectors. Securitization is, I mean, let's be honest, is still behind if we compare it to other fixed income products, especially. Do you have any views? Why is that?
So it was only recently that I started having discussions with investors with respect to pricing of ESG risk. And definitely, I think even in the past 6 months, there has been a change that before ESG used to be, it's a plus, but I'm not willing to pay for that. Now that there's starting to be dedicated sources of liquidity for ESG investable assets, that really is facilitating the discussion. Well, I don't necessarily need the same return, because I need to allocate this capital and can only allocate it to ESG-friendly type of investments. But again, that goes back to the difference. Is it ESG from a credit perspective or ESG from a sustainable development goals perspective? And I think when it comes to the asset or growth in this, it really is the latter there, which is the topic of discussion. So from a sustainable development perspective, I think the next question is, well, what are the pool of assets which are available? And I think today, without there being a definition of, well, what constitutes an ESG eligible investment, it's very difficult. And then you start just getting into circular references where, well, you need the originators to be collecting the data when they give the loan in order to then start putting it into securitized pools. It's also questions that right now, each investor has their own approach to classifying what is ESG. And that criteria can be very, very different. So for the deals that have been done, we've seen some CLOs, for example, where there's ESG friendly, but that means there's just negative screening applied. Or some CMBS deals. So there was a French CMBS deal with one property where it had a high LEED or energy efficient certification, and as a result, that deal was called green, but there's no external opinion on that. It's really up to investors to determine, does that fit into my framework? So I think one of the questions, and Anna, I believe AFME has responded on this, is should there be some sort of third-party verification similar to STS right now for deals that qualify as either green or ESG compliant?
Yeah. Yeah, that is true. Now turning to you, Anuj, from the investor's point of view, I mean, obviously, is there a demand? Is there an interest from your side?
Yeah, look, first of all, just echoing some of the points that Matt made, but just to give you a sense, a lot of our client interactions over the course of the last 6 to 8 months have heavily focused on ESG. So you can see the clients are driving towards that, towards that goal as well. So there is interest. Where we lack, and again to sort of quote what Matt had said before, is it is a bit of a chicken and egg situation, but there doesn't seem to be just enough ESG assets in Europe right now. And when you look at government initiatives or sponsored initiatives, they don't exist to create these assets, and therefore there's not enough supply to to warrant the demand for ESG specific ABS funds. There are wider ESG funds, and typically, we've looked at some of these deals that have come out of the Netherlands, where you've seen green RMBS, or you've seen student loan transactions in the UK, or you've seen some green CMBS transactions, as sort of Matt mentioned before. And we've incorporated them into some of our sort of sustainability or impact funds from that perspective. But in terms of issuance or demand, there is demand. Demand is growing. It's going to be growing sort of factor as this gets more attention, and securitization has a big factor to play in that as well, because it just warrants itself to big data and collecting information. And if you just look, if you go across the pond and look across to our neighbors in the US, they've got a more active sort of ESG sort of green securitization market over there. It's more fragmented. So you have student loans again, you have solar, you have PACE, you have green auto ABS, you have multifamily sort of CMBS for Fannie. So you have a lot more product over there, and that's, from my understanding, talking to investors over the pond, is that's created a lot more of a dialogue between investors and issuers, and you've seen a lot more ESG engagement in those sectors, and that's spurred on a little bit of demand. Again, not specific ESG ABS specific funds, but certainly the sort of other wider ESG funds have been taking a closer look in that market.
Thank you, Anuj. Yes, I think we also indicated that the lack of assets is something that is still a key issue in growing this market. So actually now when we're looking at the issue of growing the market, and we establish that there is an appetite and that there is a demand, I think it would be good to maybe think about how we can grow this market. What can we do? And I think first point that comes to the mind usually is the regulation, and here would be again question for team. In your opinion, what's the role of the regulation in this process?
Well, I mean, again, this is quite a nuanced question. I mean, both Matt and Anuj have effectively sort of echoed what a vice president of the European Commission said, which is green does not mean risk-free. And so what we don't want is to create incentives which create a market that just brings in inherent credit risk. Now, there may be sectors of the market, as Matt pointed out, that will invest in ESG purely from a SDG, a sustainable development goal perspective, but that's always going to be a minority of the market. Anuj's funds are not purely going to invest altruistically. People want returns. And therefore, we know there is an element of demand. We know that there is a lack of supply, and we look at, well, how do we marry those two in a for want of a better word, sustainable way on a credit and risk basis as well. And I think, and it's not necessarily the most popular view, I think the only way to do that is really top-down regulation, at least to stimulate the market. And again, in the context of the sustainability action plan that the EU has put in place, and through the taxonomy and its own green bond standard, there's been lots of discussion about whether we have a green supporting factor, which would affect the amount of capital that banks, funds, insurance companies also through the Solvency II regime would have to hold against assets that. And the EU is saying basically green at the moment because that's all it's really defined, and that definition took years anyway. So let's start where we are. And it seems to me, and I would really welcome what the other panelists think, given that they look at the market in a slightly different way. It seems to me that really the only way is to incentivize, and by that supporting factor, I think you also incentivize issuers as well, because they look at the pricing they may be able to achieve, and there's a specific motivation to put together a green auto deal, which we've not seen in Europe yet, but there must soon be critical mass for it to happen, at least on the asset side. And it seems to me that we're going to be stuck in a sort of minority curiosity kind of place in securitization across the ESG spectrum, unless sort of regulation pushes us forward in the short term.
Thank you, team. And if any of you, Anuj or Matthew, would like to add anything to the comment on the regulatory side?
Yeah, I'll take it there. Look, I agree with him. Right, I think there needs to be adequate incentives on both sides of the game here, right? Issuers and investors, and that will create a little bit more of a virtuous cycle of assets and demand, and holding, say, lower capital against some of these investments will incentivize the different sort of investment communities to engage a little bit more. There is a lot more focus on this sector, and whatever can be done to make that a little bit easier to invest in can only promote that sector going forward. And for me, that makes it makes a lot of sense if there is there is focus on this from a pricing perspective and an issuing perspective as well.
Right.
Sure, I'll say from a ratings perspective, I think whether it's regulation that achieves the objective or not, we'd be indifferent. We just need to make sure that there's comparability, so that the information that we're receiving is consistent and I can compare one issuer to another. So if they're using different definitions, that makes it very, very difficult for us to assess, is there a difference in the relative risk? The other point will be for going back to, well, is an ESG friendly investment necessarily lower credit risk? Is we're going to need a lot of data to support that. And right now there just isn't the amount of data that would be needed, I think, to give us comfort that it would be that ESG factor itself was a driver, as opposed to some other factor that may have a high correlation to that, but would otherwise already be captured under one of our credit factors. So I'd say until there's a big universe of data available, it would be unlikely that we would start adjusting any of our credit assumptions due solely to a specific ESG risk, like an energy efficiency risk, for example.
Yeah, yes, I think with this point we just covered kind of the point that I wanted to ask at the end, which was about the actually the prudential framework, which I was wondering, because this is a subject, a little bit of a kind of controversy here, whether this prudential framework should be driving the development of the market. But I guess there is still one other maybe question that we could touch upon. Is it anything else that you think we should do as an industry, whether it is from the transparency point of view or actually any other kind of point of view that would help to develop the market? And I think that would be maybe the last question for the panelists, and unless you would like to make any other comments later.
Look, from my perspective, it's all about engagement. It's about engagement with investors, and it's about engagement with issuers as well. Once you can have an agreement in place and a standardization of data, of quality of disclosure, that's when you can build the trust, right? And you can build the trust and build a foundation on which you can have a sustainable, for want of a better word, sort of glide path in terms of green securitization really playing a part in social investing and more issuance in this sector. Look, we've seen the lessons in the US, and there have been a lot of government initiatives over there in order to promote, say, solar panels and just efficiencies at home or on commercial buildings, and that has led to a investable universe for investors, and people have engaged a little bit more there. I guess here it just needs someone to bring them closer to the table and have that frank discussion around sort of disclosure, standardization, what's available, what's not available, what's relevant. And when we have that, I think securitization does have a very big role to play in all of this.
Yeah, I mean, I agree with all that. I mean, I think from a more legal perspective, standardization and transparency of disclosure will ultimately breed that market-based trust. And if the requirement to do that, and particularly the requirement to be consistent and standard, is driven by market participants coalescing around standards, well, that's great. If it's imposed on a mandatory level, well, I think that's fine too. But we need to get to a position where we're actually not, we need this panel not to take place in many ways. So we're talking about that ESG principles, disclosures, and risks are just inherent in normal disclosure, and and if that on a sort of detailed level, if that goes to more templates being produced under the securitization regulation, for example, which seems to me a fairly easy win, if anything in that sort of sector is easy, but I think sort of pushing that forward, so we're sort of normalizing this, and it's just another risk and just another factor that's being talked about.
Thanks. Matt, anything else from your side?
No, the only observation I would have is to one of Anuj's comments. So he was saying that, yes, there's been some government support that's created incentives around asset generation, which could be used to then do an ESG securitization. From the risk and rating side of that, we would question, well, how much of the value is actually being supported by that government intervention, and what would happen if that's taken away? So again, we would need to get to the ultimate, is it a functioning market? And what would be the downside scenario in the event that, and we've seen it with electric vehicle sales in some of the Nordic countries, there's a substantial decline in those sales once government support was taken away. And what does that mean for recoveries and deals, and how does that factor through in our stress rating analysis?
Yeah, and I mean, there are other examples as well. In the renewable energy market, we've seen subsidies being taken away and some being taken away retrospectively. And I think that it's important, again, that this is a normal market. It's not a market that relies on governmental support in order to function.
Great. Well, thank you all. I think with this, it brings us till the end of the questions that we have had prepared for the audience today. Of course, we're happy to take Q&A. So let me now have a look if there are any questions that have arrived. I'm going to manage the technology. So Q&A. Okay. Unfortunately, I don't see we have any questions. No, I don't see. I don't think we have any questions. Well, I guess we are more than happy to answer any other question that can come from the audience after the webinar. I think our contact details are available. So if anybody has any other questions or any other comments that would like to share with us, we will be very happy to take them. Let me just check one more time if there's anything that arrived, any question. Nope. Nope. Okay. Well, then we are a little bit ahead of the time, which I think it's not bad. I always prefer to be on time than run over. I guess it's a habit from the global ABS where we only have 45 minutes for a panel. So with this, oh wait, there is one question. Let me see it. Okay. Okay, so first question is, how do you explain the increasing number of green covered bonds comparing to ESG? I don't know who would be the best place to answer this question.
I mean, I think it's difficult to speculate, but essentially covered bonds are bank issuances as opposed to sort of issuances solely dependent on the credit quality of a portfolio of assets. And so maybe it's just moving a little bit more towards the corporate style of green issuances, and I think it's a little bit easier to look at that market as just a subset of the green issuance market, as opposed to solely being dependent on the performance of a portfolio. So you can actually look at a bank's more holistic activities as opposed to purely the characteristics of a portfolio. But to be honest, that's pure speculation.
Thank you. I see there are two other questions. The next one is, can we create a forward-looking rating?
I can cover this, and I'll have to speculate a bit as to whether it's credit rating versus like an ESG evaluation type of assessment on, from a sustainable investment standpoint, and ESG friendliness standpoint. So from a credit rating standpoint, our analysis today is already taking into account forward-looking factors. We believe that they will be realized over the life of the transaction. So again, there definitely is forward-looking ESG risks, which we would view as material, but the structures today would be viewed as effective mitigants to the risks because the life of the deal might be, I can use an auto deal, for example. You've got a typical 2-year weighted average life on that transaction. Do we think that it's a material risk in a 2-year period that the deal is outstanding that you have replacement of ICE engines with electric vehicles? And right now the answer is no. Definitely a deal that's issued 10 years from now, that's probably a very different question if we need to consider the impact that effective 2035, you can no longer sell new ICE engines in the UK. So I'd say today the rating analysis, where it's a known risk and a measurable risk, our analysis does account for that. Whether or not it's something that's specifically addressed or we feel is already covered by another assumption on default or geographic diversification mitigates it or something else, I think it comes down to, how is that risk sized for? On the ESG evaluation standpoint, this is something that as an organization, we would love to hear the feedback from the market on, to the extent it's a not credit opinion or some other form of ESG opinion that you're looking for, like what do you want to see? What should be included in that? Because again, to securitizations, is it only the assets we need to consider? Do I need to consider who's servicing the assets? Do I need to consider for the vehicle the entire life production of that vehicle? Like how do I dispose of the battery? Or is it only the point that it's financing? So there's a lot of questions that remain to be answered. And for a non-credit product, I think the key challenge is going to be we need to draw that box around what that opinion is going to address. But without knowing how the market wants to use it, that's what makes that very challenging.
Thank you. I see there are a couple of more questions that just arrived. There is a question here there it is. Do you think that ESG could help to expand the securitization market, or will it just substitute existing assets?
I'll take this, and I think there's another question that I can take the first bit off as well. Is a bit of an interplay there as well. So look, when I made the reference to our friends in the US and looked at the different sort of sectors over there that have been covered with green securitizations, we looked at sort of solar, we looked at PACE, we looked at multifamily CMBS. in a way, it will replace certain assets, but in a way, it will grow certain assets as well, right? So when we look at different asset classes, we don't have a lot of solar ABS in the US, in Europe, but that's not to say there's not enough solar panels. We see a lot of those investment opportunities more on the private side than on the public side, but they do exist. And I guess, picking up on another question in terms of the use of proceeds. Now, we've seen this in the US where, they've done green, say, auto bonds where they've financed non-clean or non-electric cars, but used the proceeds in to manufacture electric cars in many ways and made that assessment. That's a hard one, right? That's a hard one from an investor's perspective. And like I said before, investors fall on both sides here, right? It's a very nuanced approach in what they think about what they think about how those proceeds will be used going forward. If you have a lot of conviction with the topco or with the issuer that that's how they are going to be spending their resources, then yes, you may fall on the side of that's acceptable. But it's a qualitative assessment when it comes to that sort of analysis. And again, you're going to see investors that fall both sides of the argument there.
Thank you very much. I see there are more questions coming. I hope we have enough time to cover them. Now, which one we covered already? This one. So I see that came just a moment ago. Within a pool of residential mortgages, if I want to price in sea level risk or flood risk, how do I get this information associated to the mortgages? That's a bit tricky.
Well, I can initially, and I can talk to the risk, and then I'll leave it up to the buy side to price that risk. But for assessing the risk anyways, this is one of the key challenges is even having postal code information today might not be accurate enough to properly assess flood risk. So it's definitely based on the loan level reporting requirements, in what manner can you actually pinpoint the location of a property? And then I think the next question is, well, even if there's a small percentage of properties that are impacted, is there other mitigants in the structure? So digging into then second order risk, well, is there an insurance policy that would cover this? Does it cover flood risk, yes or no? To the extent that it's a long-term flooding risk, what type of sovereign support might be given? Are they going to put up years or not 50 years from now to protect those properties? So those are the types of questions that we're now exploring. For the data providers themselves, though, there definitely are third-party data providers today where you can get an assessment for a diversified pool of mortgages for what their exposure would be to sea level rises, flooding, extreme heat and cold, hurricanes, earthquakes, etc. So I think it's integrating that with the loan level data that we have today to come up with at least sizing that risk, and then how it's priced or looking at the mitigants to that risk is the next step.
Right. I see there are 3 more questions, and I think this is it what we could do for today. So let me see. The next one maybe we can take is there was a question about there it is. Why is e-vehicle support being taken away? The government. Does the government think it is already enough to self-sustain its growth, especially when it is an ESG investment for a retail investor? And discuss ESG still has a lot more policy framework that is needed.
I mean, if I could hazard a guess, I suspect the government feels it's probably subsidising enough right now without continuing electric vehicle support. I mean, there's a direction of travel, which is a terrible pun, I apologise, there in relation to, as Matt pointed out, the phasing out of internal combustion engines. I mean, obviously every government, be that Nordic governments, it's been reduced in the UK as well. It's a political decision about which aspects of the E or green technology to support, and we've been through this on a more macro level with subsidies for renewable energy. So I mean, I think it depends on where you are, and it depends on the political environment, I think. Yeah.
Okay, two more questions are waiting. I see there was one about checking which one we have already taken. What do you think about the cost of disclosure for SME, who are large leverage loan issuers as well? Do you think it will have an impact on the CLO space?
Look, the cost of disclosure is going to be a uniform that's going to be, it's going to be shared amongst the industry. It's probably going to be, it is a cost of doing this business. It's the cost of providing the information within which we can make or relevant and standardized information within which we can be comfortable as investors making the right analysis with that data. Will it have an impact on the CLO space? Look, we're at the infancy of all this right now in terms of data capture and data disclosure. And as investors, we want to work with issuers, with whichever space they work in, CLOs, CMBS, residential mortgages, to be able to capture relevant data that is easily accessible to the issuer or the borrower, to be able to make sure that the data that we're getting is relevant for our analysis. I don't think there's scope or there's, from our part, we don't want to burden too much data disclosure, which is not relevant for the ESG analysis, but we want to make sure that it's standardized, it's relevant for the information that we get. And there will be a cost associated to that. And then, unfortunately, as we've seen with other data disclosure requirements, will wash out and will wash out economics. And will...
Good. Gosh, there's more questions coming. Okay, let's try to answer them as they're coming in. So there was one question which is quite interesting. If we have a supply, if we have the opportunity to influence the market to create the supply, what can be done within the global networking? I think we have talked about a little bit about influencing the supply a little bit. I guess.
Well, yeah. I mean, again, I sort of expressed my view earlier. I mean, I think the supply of assets or pools which demonstrate ESG characteristics is already there. I mean, it's smaller than the wider market, and so I think in stimulating demand, you stimulate supply.
Yeah, that is true. So let's see. Two more questions. I see. There it is. ESG factors may, in certain cases, mitigate the credit risk of transaction, or in general, get it less risky. Is it reflected in the remuneration of the ABS? And if yes, in average, what's the gap with normal ABS in terms of remuneration?
I'll take it from a pricing perspective. To be quite frank with you, given what we've seen and the meager sort of issuance that we've seen in Europe, there isn't. And we've talked about this before. If we have the correct incentives from both sides, from the issuer side and from the investor side, we might start to create that gap in pricing. And it's a bit of a vicious circle in itself. You want that gap to appear to incentivize a lot more people to to issue, and investors to invest as well, because they're holding, say, less capital against those type of securities.
Great, thank you. I see two more questions. There it is. Have you seen initiatives from investors to set up ESG labeled ABS fund based on proprietary ESG assessing methodology? I think that's for you, Anuj.
Not specific ABS ESG funds, and I talked to this before. Just to reiterate, there isn't the supply to sort of meet demands for an ABS specific fund, and until we see that, I don't think we'll see ABS specific ESG funds in that department.
Good.
Sorry, I'm muted. I will say something, I'd say similar to a fund would be ABCP conduits. And there have been discussions in that space about dedicated TP conduits, which would only be funding ESG compliant assets.
Okay, and last question we have here. Do you believe that having a certification report covering certain ESG principles would help creating better trust on this new niche? So certification reporting covering certain ESG principles. So a little bit like would it be like an STS label?
Well, I mean, in many ways, I think this question is no different for securitization than for any other part of the ESG issuance market. And I mean, and again, looking at the sort of, the green bond market as the most developed part of that, I think it does help. And I think it does give at least some sort of independent view. Is it always necessary? Not in every case. I think it depends on the characteristics of the underlying issuance. But I think there will be certain transactions which will certainly depend on it. Benefit from it, and it will also help to dispel questions around whatever the equivalent of greenwashing is in the wider ESG space.
Yeah. All right, I think we covered all questions. Let me just check. Yes, I think this is all. All questions have been answered, I believe. So in this, we can, I think, close the discussion. And again, thank you very much, team Anuj and Matthew, and hopefully our audience enjoyed the panel. We can't interact with them like we would in a real life, but hopefully audience enjoy. And there is still one more webinar from ABS Global series coming up. So stay tuned for that. And otherwise, we hope we see you as well on our virtual event. And maybe in time soon, we also can meet each other in a normal environment. So I think with this, I would close the panel, and I think I hand over to IMN.
Thank you. Great job to the panel. Thank you to the audience for joining us. And just to remind everybody, if you haven't registered for the Global ABS Conference, it's free to do so. And we encourage you, so we can keep you up to date on the great keynote speakers and panels we have coming up September 15th to 17th. Thank you once again. Virtual applause for our panel. And I hope everyone has a great rest of their Thursday.